Are you a founder of a startup and you understand some basic accounting terms, but sometimes when your bookkeeper or tax accountant speaks to you, you don't really know what they're talking about? Things like OPEX, CAPEX, amortization. Hi, my name's Alysha Randall and I'm a fractional CFO. And today I just wanted to introduce to you some of those accounting terms that you may come across, just so that you get a better understanding of what on earth your accountants are talking about. I did do a very basic accounting terms video, and I'll link that above and below. So if you are brand new to accounting, you've just started your business and you don't know where to start, then maybe start with that one first, and then this is the next one. So essentially it's a glossary, but sometimes it's useful hearing someone talk about it rather than, just reading it off a list and trying to get your head around it. So the first one I wanted to talk to you about was amortization. So you may have heard about depreciation. As I said, I did talk about depreciation in the first video, but amortization is basically the same thing, but it's just with intangibles. So if you buy a computer, you recognize the cost over, say, 36 months. So it would go onto your balance sheet and then would go onto your P&L over a 36-month period. And again, balance sheet and profit and loss, I also have done videos on both of those if you want to understand those financial statements a bit better. But amortization is the same, but it's looking at intangibles. And intangibles basically are things you can't touch. So it could be if you spend a lot of money on creating a website, any kind of tech intangibles, copyrights, trademarks, those kind of things. Amortization is also recognizing the cost of those things over time. So it'll first go on your balance sheet as an asset, and then it won't be as valuable as time goes on. So for example, with a website, say you spend 36, let's make my life easier. Say you spent £50,000 or dollars on creating a website. You put that on your balance sheet as a cost, and then you assume that that is going to be, in about 5 years' time, you're probably going to have to update that. So every year you would recognize £10,000 going through your P&L, and every year at year end, the value of your website would decrease because it's getting closer and closer to the point in time in which you need to update them. So that's amortization. The next one is CAPEX, or capital expenditure. Essentially, that is just the cash that you use to pay for something that's going on your balance sheet, which is generally an asset. So if you're buying a computer for, say, £2,000, generally this doesn't go into your P&L, it goes onto your balance sheet and is depreciated over time. So this £2,000 would be CAPEX, capital expenditure. You're buying capital and it's costing you money. Similarly, OPEX, or operating expenses, these are the expenses that you incur for your day-to-day operations, and they go into your P&L. So paying someone's wages, rent, all of those kind of things, they're your OPEX, they go through the P&L. The next thing that you may have heard of, particularly with cash flows, and again, I've got a video explaining cash flows, is working capital. In general, this is the difference between the company's current assets and current liabilities. So the way I like to think about it, more from a business perspective rather than the definition, is it's how much money essentially is going in and out of the business. So if your sales that you make are via invoice and you have to wait for people to pay for these invoices, your working capital can not be great if you have to wait a really long time for these invoices to be paid. And then similarly, when your working capital also isn't great, is when you're paying for things upfront or in advance. So in that instance, your working capital is potentially negative because you keep making sales but not getting paid for them, but your expenses, you have to keep paying for them upfront or even early. And in that instance, you will run out of cash. So you really need to then look at the working capital, which means how quickly can you get money in and how much can you delay the expenses going out. And that is really important for a startup. So working capital is essential. Leverage. So this is the use of borrowed capital, so a loan or an investment, and you're expecting the profits you make off this to be greater than the interest. So for example, you buy a machinery that is going to create a product that you can sell. And the profit you get off these products that you sell is far higher than the interest you have to pay that you to the company that you borrowed money to pay for this machinery, if that kind of makes sense. So therefore, it would, in this instance, it would make sense to borrow money to buy a machinery because then it's not as expensive as the revenue would generate. So whenever you're looking at whether to borrow or not for a piece of machinery, it's worthwhile considering whether you have good leverage or not. If you have good leverage, like in this example, go for it. If you don't, then it's probably not the best idea. Equity financing, I mean, if you've been working in startup and scale ups quite a lot, you will know what this is. It is essentially going to investors, angels, VCs, PEs, and looking for investment by selling your shares, essentially, so that, that's the trade. So equity finance is in your equity part of your balance sheet, you have share capital, share premium, and you are basically selling that part of your business for an investment. Similarly, then there's debt financing, which is borrowing money that has to be repaid over time with interest. So it's always considering what is better, debt or equity. There are pros and cons with both of them, and I will definitely be going through that over the coming weeks because I think it's a really important consideration for a founder. Return on equity. So this is very much a measurement that a listed company would want to show, but it's also something that your VCs will potentially also look at. Less so for a startup or scale up internally, but essentially it's a measure of the financial performance of the business calculated by, you have your net income divided by the shareholder equity. So how much has been invested in the business and how much revenue has been generated off the back of that investment. So it's definitely something, as you could see, that investors are very much interested in. Then we go switching over to the P&L, we have a couple of things that you may have heard of, which is EBIT and EBITDA. So it's not just revenue minus expenses equals profit. There are different subtotals towards the bottom of your P&L. The first one is EBITDA, and that is earnings before interest, taxes, depreciation, and amortization. So it's all of your revenue minus the expenses except for interest, tax, depreciation, and amortization. And the reason for this is that depreciation and amortization are non-cash items, and interest and tax, they aren't generated due to day-to-day operations. So the efficiency of the business is not really reflected by interest and tax directly. So when an investor is looking at a business and working out how much the business is spending, interest and tax, depreciation, and amortization may not be a key factor. I personally prefer EBIT because I feel that if you're spending a lot on CapEx or you're putting all of your tech spend through CapEx, I want to see how the depreciation and amortization is affecting the overall profitability of the business. So I prefer EBIT, and that is just earnings before interest and tax. So this is an indicator of the company's profitability of revenue minus expenses, excluding tax and interest. Obviously, sometimes interest can be interesting. So this is both interest revenue and interest expense, particularly if there's a lot of debt, but that's obviously highlighted quite clearly on the balance sheet. Then we have direct costs, indirect costs, fixed costs, variable costs. I do go through these quite specifically in the P&L. Direct costs and indirect costs, they're generally, if you sell a product, what do you absolutely have to spend in order to get that product to a client, whether that product or service? And then the indirect costs are things, such as rent or, all the things that don't necessarily you can directly attribute to a specific sale. Fixed costs and variable costs is exactly as it sounds. So rent, for example, would be a fixed cost. It's the same every single month. It doesn't matter how much your revenue is or how low it is. You still have to pay the same rent. The only way that it'll change, obviously, if you renegotiate or move. Variable costs are the ones that more aligned with your cost of sales. So, if your revenue increases, your variable costs would increase as well. Break-even analysis. So this has certainly become a real focus over the last, say, 6 to 9 months. As a founder, growth was probably a bigger factor and a break-even point less so. But I would say break-even point is becoming much more important also as you're going through a fundraise. So this essentially is an assessment to find out at which point a project sometimes, or the business as a whole, will become viable because the revenue equals costs. And obviously with startups, it's often not the case. The focus is to drive growth and eventually get to break even, but your road to break even is becoming more and more important. And finally, I just wanted to touch on goodwill. This is obviously important if you do an M&A. So it's an intangible asset. So you'll see it in your fixed assets on your balance sheet that arises when a buyer or a business buys or acquires an existing business. So the goodwill would generally represent the value of the brand name, the IP, the customer base, customer relations, employee relations, and patents and any proprietary technology. So the way that this is treated long term depends on which accounting standard you're part of. Either the goodwill is revalued or it's amortized, but essentially that's what goodwill represents. And so you would see that if your business has purchased another business, or vice versa, you've been purchased, it would be on the company that purchased you. Anyway, so that was the second round of accounting terms. I will do a third, but again, if you really want to go back to the basics, particularly with financial statements, I go through all of those, and the links are below. I try to upload a video quite regularly, so please subscribe, and I will help you ensure that you really understand finances with your new startup. Cheers.